Welcome to Debt Matters. Now, if you're in commercial finance, you've almost certainly run into this problem, and it is frustrating. The B2B gone away debtor. We're not talking about a client who's just a bit late on an invoice. We're talking about a company that has, well, effectively vanished.
Right. They've just gone dark. All communication stops. Their known location is empty.
Uh-huh.
And this shifts the problem from, standard collections into something much more complex.
It becomes an investigation.
Exactly. It's an investigation. So today, we're going to look at how you can actually trace these debtors successfully. But, and this is the crucial part, how you do it legally and ethically, making sure every step you take holds up.
That's the mission, then. We want to give you the tools to trace these businesses effectively, but also highlight the boundaries, the lines you absolutely cannot cross if you want your claim to stand up in the end. Okay, so before we even get into the actual methods, the tracing part, let's talk about compliance. It feels like the boring part, but why is it the absolute first thing to consider? What's the real risk of, just jumping in and trying to find them?
The risk is it's foundational. It's everything. If you get the process wrong at the start, legally wrong, you can forfeit your right to recover that debt. It doesn't matter how much you're owed.
Wow, okay. The whole claim could be gone.
Gone. And there's more. We're talking B2B, but you are still processing personal data.
You mean the data of the people involved? Directors, shareholders?
Exactly. Their names, their contact details. If you mishandle that information, the creditor themselves can face legal action under data protection laws.
So the company might be gone, but the privacy rights of the individuals behind it are very much still there.
They are. And that's a critical distinction to make.
So with that in mind, what's the first step? The non-negotiable, mandatory first action for any creditor.
It has to start with maximizing your internal efforts. And that begins with one simple but often overlooked thing: data cleansing.
Data cleansing.
Yes. You'd be surprised how many creditors jump straight to hiring an external tracer when their own house isn't in order. Your internal records have to be clean and up to date.
And when you say data cleansing, we're talking about more than just checking a postal address, right?
Oh, absolutely. This needs to be rigorous. First, cross-reference everything with public registers, like company's house.
Yeah.
Verify the last known registered office. Check the current director status. Look at the filing history. Is there a proposal to strike off notice? That's a huge red flag you need to know about internally.
So you're building a complete picture from what's already out there.
You're auditing your own information against official sources.
Yeah.
Check the communication history. The emails you have, they still link to an active domain. It's all due diligence.
And that internal work, it's almost like a procedural shield for later on.
It is. But there's another legal concept that comes into play here, even at this early stage: legitimate interest.
Okay, explain that.
Well, under GDPR, if you're processing personal data, like a director's name to chase a debt, you need a lawful basis. For this, it's usually legitimate interest, and you can't just claim it. You have to document it.
You have to do an assessment.
A legitimate interest assessment, or an LIA. You have to write down why tracing this person's data is necessary and why your need to recover the debt outweighs their right to privacy.
So that piece of paper, that LIA, is what separates a proper legal process
from a fishing expedition that could get you fined later. Precisely. It turns frustration into a structured process. And only when you've done all that and the trail is still cold, only then should you think about bringing in external help.
Right. So you've done all your internal homework, the LIA is documented, but you've still got nothing. The trail is properly cold. So now we're talking about professional tracers. How are they different from, say, a standard collections agency? What do they bring to the table in a B2B context?
They are operating in a completely different data environment. We can all check company's house. That's public information. But professional tracers, they have access to proprietary databases, commercial data streams that link directors to other companies, specialized corporate records.
Things the average person can't just look up.
Exactly. They can connect dots that seem unrelated. Maybe a director has just registered a new company in a totally different sector. Or they can verify a new business address through commercial property data. They are specialists in verification.
Okay, but if you're the creditor and you outsource this, you're still on the hook for compliance, aren't you?
100%. The liability doesn't just vanish.
So how do you vet a tracing agency? How do you make sure they're not using questionable methods that could come back to bite you?
Due diligence is everything, and you have to look beyond their success rate. You need to ask them directly about their compliance framework. Where does their data come from? Are they just scraping websites, or are they using licensed, verifiable data feeds?
You want to see their policies.
You need to see their internal privacy policies, yes. And, crucially, ask to see the templates they use for their own legitimate interest assessments.
Ah, so they need to be doing them too.
Of course. If they can't show you documented proof of how they operate within the law, you are taking on a massive risk. Under GDPR, remember, you're the data controller, they're the processor. You're both responsible.
So if they find the director using some non-compliant method, the whole recovery effort is...
It's tainted, legally tainted.
So the burden is really on the creditor to act like an auditor here. It's not enough for an agency to just say they're compliant.
No, they have to prove it. And that level of scrutiny, that's just the cost of doing business in this space. And it's so important because once they find the information, there's a whole other layer of rules about how you can actually use it.
Okay, so let's get into that. The legal framework. What are the big pillars we need to be aware of?
There are three, really, that you have to navigate at the same time. There's GDPR, which we've touched on. Then there's PCR. And finally, the Insolvency Act, 1986.
Let's take GDPR first. Give me a practical example of where a creditor could trip up here, even after a successful trace.
Okay, let's say the agent finds the director's private home address. Great, you found them, but using that private address for routine debt collection letters. That's a huge escalation in terms of privacy intrusion.
Right. It's different from sending a letter to a registered business office.
Very different. The director's right to object to that kind of contact is much stronger. In your LIA, you would need a very, very good reason to justify it. A safer course of action is often to use that home address only for the formal service of legal papers, not for general collection activity. That distinction is key. It stops it from looking like harassment.
That makes sense. Okay, so GDPR is about how we find and store the data. What about PCR, the Privacy and Electronic Communications Regulations?
PCR is all about how you contact them electronically. So emails, phone calls.
Let's say the tracer finds a bunch of new email addresses.
Right. Now, for B2B, the rules are a little more relaxed, but only for corporate email addresses, accounts at company.com. The second you get a director's personal mobile number or their private Gmail address, PCR vigilance needs to go way up.
You can't just start firing off automated emails or using call systems.
Absolutely not. That's a fast track to a PCR violation, which comes with its own fines. And again, it could damage the admissibility of your evidence later. The rule is always use the least intrusive, most professional method of communication you can.
Okay, so that covers locating them and contacting them. But you mentioned a third piece of the puzzle, the Insolvency Act. Why is that one so important?
Because it often explains why the debtor disappeared in the first place. A company vanishing is often a symptom of a formal insolvency. They might be in liquidation or administration. A proper tracing effort has to include checking the official insolvency registers.
And if they are, what does that change?
It changes everything immediately. If the company is in a formal proceeding under the Act, you're generally barred from any direct recovery action.
So you can't keep chasing them.
You can't. And you shouldn't. You have to stop contacting them directly and instead deal only with the appointed insolvency practitioner, the administrator or liquidator. Continuing to chase the debt yourself would be a legal violation and, frankly, a total waste of your time and money.
So you could spend months and a lot of cash tracing a director, only to find out the company went into administration 3 months ago.
It happens all the time.
And at that point, your entire strategy has to pivot.
Instantly, you stop being a debt collector and you become a claimant. Your goal is no longer to get payment from the director, but to formally register your proof of debt with the practitioner. The Insolvency Act changes the entire game.
It's so clear from this that procedural rigor isn't just about avoiding a fine from the ICO. It's about making sure the path to recovery, whatever it looks like, actually stays open.
That really is the key takeaway here. For any business in B2B recovery, it all comes down to procedure. You have to prioritize data cleansing. Make it a continuous, documented part of your internal process. And then if you do outsource, you must rigorously check that agency's compliance with GDPR, with PCR, and critically, their awareness of the Insolvency Act.
It's that blend of investigation and watertight legal procedure.
That's where success lies.
This really does provide a much clearer map for what can be a very challenging terrain. We often frame debt collection as a purely financial problem, but this shows it's just as much an information management and legal compliance challenge.
And think about it this way. How much time and money is wasted by creditors chasing debts they legally can't recover just because they didn't do a simple check on the insolvency register? Knowing the role of the Insolvency Act just reorients the whole approach. It takes what feels like a chaotic, frustrating search and turns it into a structured, logical process,
Provided you follow the
provided
rules.
you follow the rules.
Thank you for joining us for this analysis on B2B debt tracing. We hope this knowledge helps clarify the path forward and ultimately protects your claim.